Yeah. Okay. Let's kick off. So today we're focused on valuation. And when you think about valuation, try not to think of it as a single formula where you simply enter inputs and you get an output. In reality, it doesn't work that way. Try and think about it as how the market judges the quality, risk, transferability, and the potential upside of your business. And the dirty little secret about valuations is that they can be sliced and diced in a million different ways depending on a buyer's specific motive, strategy, and their appetite for risk. And the reason that matters is quite simple. In M&A, buyers underwrite risk around the quality of the process and around the business. So a strong company can still be discounted if the story is unclear, if the data is messy, or if the founder seems uncertain about what they want moving forward. And in theory, you can hire the greatest accounting firms in the world to develop a valuation for your business. But remember, your business is worth what a sophisticated buyer is willing to pay. Let's assume that valuation report is perfect and you present it to a single buyer, for example. They'll find a dozen ways to discount you and you'll not have a leg to stand on. And the reason for that is because you don't have any leverage. We have a saying that if you're speaking to your buyer, you're speaking to no buyers. So the one true way to understand what your business is worth and apply maximum leverage during negotiations is to run a global market calibration process and speak with multiple buyers at the same time. So for those of you that don't know me, my name is Elie. I'm a director at Venero. I joined at the turn of the year. Before that, I was with another investment bank, again, helping founder-led businesses maximize their value. And before that, I was a two-time founder myself, two tech companies. I had two exits, one decent, one not so decent. But like I've said before, incredible experiences. And now I enjoy spending my time with the Venero team and specifically Georgios, helping founders navigate through M&A and protect their upside and maximize their leverage. So before we kick off, just a word from our managing partner, Georgios, on Venero, and obviously he'll introduce himself.
Yeah, great. No, thanks, Elie. It's great working with you too. So for those of you who don't know me, so I'm one of the partners here at the firm. Been with Venero for about 10 years. I was at Deutsche Bank and Morgan Stanley before that, doing M&A across EMEA, yeah, started my career back in New York 25 years ago. It's been a while, and yeah, excited to be sharing some of the insights that we've picked up along the way here, specifically when it comes to valuation. And as Elie said, valuation is not a formula. It's a narrative. It's a discussion between parties, and a lot of factors play into those discussions, be from the narrative, the process, the competitive tension, perceptions, amongst the buyers, and a lot of other things I will cover today. So on the next slide, I think I have a few words on Venero for those of you who don't know who we are. So we're an investment bank focusing on primarily sell-side M&A. So about 70% of what we do is sell-side M&A. We also help companies with equity financing advisory and debt financing advisory for larger ticket items. We are a partner-led firm, so we have senior bankers leading transactions from beginning to end without handing them off to more junior staff. We have access to an international buyer network, and we bring to the table also deep market insights and expertise. Next slide. The team, yes, the rest of the senior folks here on the team are all either folks like Elie, who are ex-operators who've been working with in their respective sectors during their entire career, have had exits, or are ex-bulge bracket bankers, for HSBC, JP Morgan, Crédit Agricole, Rothschild. Next slide, our coverage is quite international. So we have folks sitting across Europe and the US, and we run mandates globally. So from Australia and Southeast Asia to across Europe, North America, South America, and offices in different cities around the world. And then in terms of deals, so in terms of deal sizes, so we focus from on the mid and lower market. So on the low end, from a few tens of millions of enterprise value to a few hundred million, 300-400 million. That's our sweet spot. Most of the transactions that we work on are cross-border. There's a lot of that activity going on. So more than, I think, probably 70% plus or 75% of the deals that we work on are cross-border. So a lot of appetite from out-of-market buyers to transact. Elie, over to you.
Thanks, Georgios. So today's webinar, we're going to tackle the one main theme, or show you how we answer the following question. And the question is, how do you maximize the value of your business before you even ever receive an offer? And this is something we talked about yesterday, and we're going to build on it today and go in a little bit more detail. Most founders naturally focus on the valuation itself. They want to know what the multiple for their businesses, what comparable companies have sold for, or what a buyer might pay. But like we mentioned, valuation isn't formulaic, and it's not driven by a single event. So long before buyers arrive at a number, they're making hundreds of smaller judgments about the quality of the business, the risks they see, how much confidence they have in the future. So that's why we've structured today's session around 3 practical value levers. First, we'll look at what buyers actually underwrite. We'll separate the metrics that generally move valuation from the ones that often you might spend too much time worrying about but don't have as much weight. Second, we'll talk about market calibration. This is an area where we see a lot of value being destroyed. Founders might become anchored to a number before the market has had a chance to understand the opportunity. And we call this in the previous session the valuation trap. Finally, we'll look at bidder tension. A well-run process doesn't just improve headline valuation, it can improve the structure, which is cash at closing. It could reduce earnouts, shorten exclusivity, and give founders a much stronger negotiation position. And then we'll wrap it up with a real-world example that brings all of these ideas together and show how buyers think about valuation in practice. All right, so the narrative that we use to map your business to these 4 pillars typically determine whether an M&A process creates a strong outcome or not. Value maximization is supported by an understanding of the factors that underpin successful M&A deals. So these include, any current market tailwinds and headwinds, the type of diligence acquirers do to assess the target company's appeal, as well as the rationale and the kind of motives potential acquirers tend to explore during a transaction. So if we take a look at these 4 pillars, the first is market conditions or timing, you can call it. Even strong businesses are affected by the broader market. So market timing is crucial. And that's a reflection of public trading multiples, financing markets, investor sentiment, precedent deals, and the specific momentum of the sector that your business operates in. All of these factors influence buyer behavior. The second is company positioning. This is the internal timing question. Is the company at the right scale? Is growth where it needs to be? Are the shareholders aligned? Is the management team ready? Are there issues that could affect valuation or diligence? The third is the buy-side view. This is about understanding how buyers diligence the company. Strategic buyers and financial buyers often assess the same business very differently. Strategics focus heavily on fit, roadmap, customer overlap, product, or on geography, whereas financial buyers focus more on growth, retention, profitability, and scalability. And what they're trying to do is answer one question. If I buy this company at X, in 3 to 5 years, can I sell it at 3 or 4X? And to give you an example of that, I once reached an impasse with an evaluation discussion with a private equity buyer in one of my deals. When we started talking about their strategy and how they need to create an arbitrage in order to adhere to their investment strategy and get it past their IC, that's only when we were able to start getting creative with EV and structure and move the deal forward. The fourth one is the buyer universe. Once you understand the market, the company's positioning, and the lens in which the buyer is viewing the opportunity from, then you can identify who's most likely to have a credible reason to engage. And that's where the process strategy and the process design starts becoming a lot more specific than generic, and that's where the narrative becomes important, and how you map a business's strength to a buyer's acquisition mandate.
Yeah. So I think on this slide, I think the main takeaway is that timing is crucial, and I think everyone probably gets it. It's one thing to sell a business in 2019, and then the same business to sell it today. Same company, different time, market timing, a world of difference. And then under buyer universe, right? Everybody again thinks about valuation as being a formula, as being a discussion and negotiation, right? But what is probably the most important factor in this discussion and this negotiation is who sits on the other side of the table, right? Who are the buyer that you're talking to, and how motivated is that buyer? So when it comes to the fourth pillar here, which is the buyer universe, making sure that you have on the other side of the table a buyer that is who's motivated, right? More motivated than everybody else. That makes a huge difference in valuation, because the same asset, whatever formulas and DCFs and comparables you can throw at it, the same asset may be worth very little to one buyer and then a heck of a lot to a different party. So same asset, different buyers, different valuations. So that's a crucial point. Not much you can do about it, right? You just need to make sure that those motivated buyers are at the table.
And let's take a look at how strategics view deals. A strategic acquirer is basically a business that operates in the same or adjacent sector as your business. They're essentially a business that's selling something. They may share similar customers or geographies, and sometimes they could even be competitors. Strategic buyers, as the name implies, will start with the strategic fit question. The question, they'll ask, do we need this capability? Is it on our roadmap? Does it fit our customer base? And then the important one is it better to buy or build this functionality? I.e., would it enhance our roadmap and product go-to-market timelines or not? The second key area for strategics is geographic fit, either to beachhead into a new market or to consolidate a market. The third is financial performance. Buyers look at the business as it stands and pro forma. The question buyers will be asking is, how much can our distribution channels re-accelerate new logo growth? And then the fourth is scale. Will this be a bolt-on that enhances the product offering and team capabilities, or is it a play that will completely transform the business? Financial buyers look at the same business through a very different lens. They might already be thinking about the next exit before they've completed this acquisition. The questions tend to revolve around value creation, things like, can we improve the margin? Can we accelerate growth? Can we complete additional acquisitions around this platform? Ultimately, they're asking one key question: can this business be worth materially more in 4 to 5 years, or whatever their timeline is? That's why operational discipline matters so much. So strong reporting, predictable forecasting, scalable processes, and obviously a capable management team. And if you've watched or attended webinar 2, you'll start to see how these themes carry through at each stage. So these things reduce execution risk, they give financial buyers confidence, and they can help them deliver on their investment thesis.
Yeah, and I think you'll notice here that a main difference between strategics and financial buyers is that the first question a financial buyer will ask is this market worth pursuing, right? What's the market opportunity? Because a financial buyer, they could go into health tech, they can go into cybersecurity, they can go into any industry. Right? So the first thing they need to do is get comfortable with the industry that you're in. A strategic doesn't do that because they're already in the sector. But the first thing a strategic needs to understand is the tailwinds and the timing for entering a particular sector. Why enter it now? Right? Is now a good time to enter? And then once they've gotten comfortable with the sector, the second thing they're going to look at is, okay, if I'm going to go after this sector, is this a company that I need to be backing? Right? Why this company? Is this company, does it have a competitive moat? Does it have a competitive advantage? Why would I back this horse over anybody else? And then as a third level, they will look at the financial performance and all those KPIs. And then finally, as Elie mentioned, they will think about their exit. They'll say, well, if I buy this company now, everything is looking great now. Do I think I can sell it, 3 to 5 years from now? And if so, how? Right? What would be my exit path? So those are the things that a financial buyer would look at. A strategic will not look at, for example, the exit options, because they're they're not planning to exit in a few years' time, the company again. I would say the last thing about financial buyers, there's a saying, financial buyers, they make their money on entry, not on exit. So they make their money when they buy a business, because so a lot of times the financial buyers will pay sometimes a discount to strategic buyers, and also because they don't have the synergies. So sometimes they need to close a valuation gap with additional proceeds for the founders on exit. So when the private equity exits, then the founder will exit, and that's how they would bridge and maybe even exceed the valuation differential between them and a strategic.
Okay, so let's shift gears and look at the core drivers in more detail. And again, I love starting with misconceptions. One of the biggest misconceptions we come across is that buyers value the businesses the way founders do, and they simply don't. Founders naturally focus on what they've built. Buyers focus on what could stop them achieving the return they're underwriting. And every acquisition is really a balancing act between upside and risk. Strong growth creates confidence. Weak retention destroys confidence. A differentiated product creates confidence. Founder dependency reduces confidence. So it's that balancing exercise that ultimately shapes valuation. We've simplified it into 4 areas. The first is growth and revenue. Buyers want to know whether the growth is sustainable or whether it's being manufactured through things like discounting, one-off projects, or aggressive marketing spend. The second is retention and concentration. High retention tells buyers customers are receiving ongoing value. Concentration tells them how exposed the business is if one customer leaves. Third is margin and scalability. Buyers aren't buying today's EBITDA per se. They're asking whether margins improve as the business gets larger. And then finally, strategic relevance. Does this business strengthen the buyer's existing platform? Does it solve a problem? Does it accelerate a roadmap? Those questions often separate average valuations from the premium ones. The important point is that buyers aren't adding up scores across these categories. They're forming an overall level of conviction. The stronger that conviction becomes, the more aggressively they're prepared to compete. And some metrics matter more than others because they tell buyers something about the quality of the business beneath the surface. If you look at ARR growth, 20% growth sounds good, but in a buyer's eyes, they might ask where it came from. Was it through new customers? Was it existing customers? Was there a change in pricing? Or was it through an acquisition of another company? Are you acquiring revenue, or is it through one large contract? So you can start to see why growth on its own rarely tells the full story. And the same applies to retention. Gross revenue retention tells buyers how well you keep customers. Net revenue retention tells them whether those customers become more valuable. The expansion revenue, are you winning new business? And together they provide a much clearer picture of customer quality than revenue growth ever could. So gross margins are another important indicator. High gross margins suggest the business can scale efficiently. Lower margins become increasingly expensive when you're trying to scale. There might be bottlenecks or dependency on people, for example. The rule of 40 is still widely used because it balances growth with profitability in a single measure. It's not a perfect metric, but it gives buyers a quick sense of the quality of the business. And then sales efficiency might tell buyers whether the growth is being bought or whether it's truly earned. And finally, forecasting credibility. This one is often underestimated. Buyers aren't just assessing this year's forecast; they're also looking backwards. Typically, they might look 3 years back from that point of the transaction or when the process is running, and they're going to ask themselves, did management say they would grow by 20% last year? Did they actually deliver it? So management teams that consistently do what they say build trust very quickly during a process.
And in these metrics, they also shift over time, like the benchmark that the buyers hold their targets to versus these metrics also kind of change over time. Profitability, for example, used to not be very important a few years ago. Now it's becoming increasingly a topic. GRR used to be, secondary to NRR. Now it's the first thing that people look at. And then Rule of 40, sometimes also people start to look at Rule of 50 or more. So these things have to shift over time, but yeah, this is where we are today.
So I think by now we've established that growth on its own doesn't tell the full story. Another mistake we see people make is assuming that all growth is the same. From a buyer's perspective, it isn't. And I'll give you an example. Two businesses can both, be growing at 30%, but one attracts a premium valuation while the other gets heavily discounted. And the difference is what's driving that growth. Is it efficiency, or is the company spending aggressively just to stand still? Is the revenue already contracted, or does the next year's forecast depend on winning deals that haven't entered the pipeline yet? Or is growth spread across hundreds of customers, or does it rely on one or two large accounts? And perhaps most importantly, is the commercial engine repeatable, the go-to-market? For example, if a founder is personally involved in closing almost every major customer, major transaction or major customer, then that creates risks. Buyers immediately start asking whether, what happens when that founder steps back after the acquisition. So growth becomes much more valuable when buyers believe it can continue without an extraordinary effort. And that's why underwriting the quality of, and that's why they're essentially underwriting the quality of the growth and not just that percentage. So if valuation was purely a financial exercise, every buyer would arrive at roughly the same number, and that almost never happens in practice, which is why market calibration is so important. We've run processes where most buyers clustered around a similar valuation, as Georgios mentioned at the top of the presentation. Then one buyer came in materially higher, so you have the outlier. The financials didn't change. What changed was basically how that buyer saw the strategic opportunity. And this is a really important point. Who's sitting across the table from you, the motivated buyer, is critically important. Maybe the technology shortens their product roadmap by a couple of years. Maybe the customer base opens a new vertical. Maybe the acquisition solves a capability gap that they've been trying to address internally for a long time and haven't figured out. That's why non-financial drivers matter. Product differentiation creates, barriers that are difficult to replicate. Customer embeddedness makes revenue more durable because replacing the software becomes extremely painful. Expansion relevance gives buyers an opportunity to accelerate something they're already trying to achieve. So these are the factors that explain why strategic buyers sometimes will pay above what a financial buyer considers reasonable and far above where the median bidders are coming in.
In some cases, it's something even more nuanced. I mean, people will talk about synergies, and that's a big part of kind of valuation negotiations, synergies between two strategics, and how the value of those synergies will be allocated between the buyer and the seller. And we have one situation where the buyer had a contract that was worth in the hundreds of millions, and they needed the target in order to win that contract. Well, I can tell you, we were able to extract significant, like a multiple that was, a stratospheric multiple, even for boom time, by boom time kind of metrics. Simply because the buyer had such huge upside to gain from this acquisition, and they were willing, and we managed to negotiate them to a point where they shared a significant, a very big part of that upside with the seller. In another instance, right, it's a buyer that may be losing business, right, because they don't have that particular product or company. They have a mandate from their board to buy and not build a particular offering. And these guys they were able to move quickly, right? As Elie mentioned, above and beyond, like a significant premium versus a silver medalist. And yeah, and that had to do with the fact that they were a motivated buyer versus much more motivated than everybody else.
So let's move from business quality to the valuation itself. One of the first questions founders ask us is, what do you think our business is worth? And it's a perfectly reasonable question. The problem is that answering it too early can actually damage the process. In the second webinar, we called this the valuation trap. So we regularly see founders and CEOs anchored to an old funding round, or a competitor that sold 3 years ago, or a headline multiple they read online. But markets move, buyer priorities move, capital markets move. So think of valuation as not static, but as dynamic. It changes depending on who's buying, why they're buying, what alternatives they have, and what the competitive process looks like. That's why letting the market speak and not leading with valuation is so important, and we'll dive into that a little bit later as well. So what do I mean when I say let the market speak in practice? And this often surprises founders. One of the most valuable things an advisor can do, or founders for that matter, CEOs and founders, when you're having these conversations, is resist the temptation to give the market a valuation too early. Why? Because buyers don't know enough yet. At the beginning of a process, or in a first conversation, they might have seen a teaser, they might have had a short presentation, or they might even have had a management meeting, but they haven't understood the product, they haven't explored the customer relationships, they haven't identified the strategic upside, they haven't understood the capabilities of the team. So if you anchor valuation at that point, you're asking buyers to react before they've built that conviction. So a good advisor does the opposite. They create enough interest for buyers to invest time to understand the opportunity. And once buyers begin seeing the strategic value, they're in a much better position to tell you what the business is worth to them. Sometimes that aligns with your expectations, occasionally it exceeds them, but the market doesn't reward confidence, it rewards conviction. And those are two very, very different things.
Yeah, and of course, there's always nuances, and this is not, things change on a case by case basis. I mean, there are instances where you would rarely lead with a valuation before the buyer has a chance to get to know you. But whether you anchor them or not, and when you decide to do that, it can vary, right? So there's always flexibility, and always an experienced advisor will be able to say, okay, now's the right time to do this, or now maybe it's better to do the other thing. But yeah, I think as a principle, it's important for buyers to understand what your full kind of worth before a number is discussed.
The third lever, excuse me, tongue twisted. The third lever is bidder tension. If I had to choose one process lever that consistently creates better outcomes, it would be competitive tension. Excuse me. Human behavior changes when people know that they're competing. We've seen buyers improve price, increase cash consideration at close, reduce earnouts, relax contractual protections. None of those improvements happen because the business changed. They happened because the competitive environment changed. One buyer negotiating privately has a lot of leverage, too much leverage. But 3 qualified buyers working to the same timetable create a completely different dynamic. That's why the process matters as much as the preparation. And a good process creates a market. And markets create pricing and optionality for the founders. So the important thing here is that bidder tension requires quality, and that's there's a very important qualification here. Competitive tension only works when the buyers are credible. So having a quality set of buyers versus a huge set of buyers. We've seen processes where founders tell us they've had conversations with with dozens of buyers. Unfortunately, many of those buyers may never be realistic candidates. They might be looking for information. They might be just window shopping. It creates activity, but it doesn't create leverage. We'd rather have 3 buyers with genuine strategic fit, funding, funding certainty. They have the money. They've got the clear internal process, the clear mandate, versus 20 buyers that are going nowhere. So the process also needs discipline. Everyone should move through the process stages at roughly the same time. If one buyer gets too far ahead, they often ask for exclusivity before we've had enough time to build that that competition, and that's usually where leverage starts leaking out of the process. The objective is to create informed competition between buyers who generally want the asset and are interested in it.
Yeah, and this is, I mean, just to make it a bit more kind of real and tangible, right? It's just if you picture yourself having no another offer, having just a single offer that you're discussing, and maybe, maybe it's okay, maybe it's not, but you don't want it to go away, you would naturally act a bit more timidly towards it. Your nonverbal signals might imply that, okay, they're the only game in town. And think about how this immediately changes once you have a second offer on the table that creates a floor, right? And how you will be able to play one versus the other, how much more confidently you might approach the lower offer to get it to increase. So having this tension changes everything, including kind of your teams and your advisors' verbal and non-verbal cues.
Yeah, that's a great point. That's a great point. Sometimes the things you don't notice in the way that you present yourself, the confidence that you have when you've got another offer can translate to the buyer versus not. All right, so let's have a look at a case study. So I think now we've established how strategic and financial buyers assess businesses. We looked at the four M&A value maximization pillars and the value maximization levers. And now that we've established that framework, we'll run you through a case study on how this works in practice and how a process can be designed to maximize that value and increase the probability of a transaction closing. So just a quick recap. This slide brings together many of the themes that we've discussed already. Founders sometimes ask us which metric matters most, and there isn't just one. It depends on the buyer. Buyers are looking for consistency across the business, strong growth supported by strong retention. They're looking for healthy margins supported by efficient customer acquisition. They're looking for a differentiated product backed by a capable management team, and this is especially true now with the threat of AI. So each metric reinforces the other, but the opposite is also true. One area of weakness doesn't necessarily kill a deal, but several weak areas usually start compounding. The businesses that command the premium valuations are rarely perfect, but they're consistent. The story makes sense, the metrics support the story, and the management has a track record of delivering what they say they're going to deliver. And that's what gives buyers confidence and conviction to underwrite a premium. So how do we achieve a premium valuation? First mistake founders make is assuming that valuation moves in a straight line with revenue, and that it doesn't. And I'll give you an example. If ARR has grown from 10 to $15 million per year, the company's clearly bigger. But if the market multiple has moved from 8 to 4 times revenue, the valuation can still fall significantly. It's got nothing to do with how the company has performed. It's just because the market is pricing risk differently. So the job of an advisor isn't to defend a static number. Our job is to position and develop the narrative for the company based on today's buyer universe, today's capital markets, and the company's actual business metrics. So let's take an example of a business we sold. They're doing about 50 million in revenue. They're growing about 22%. Median multiples at the time were between 4.3 and 6.5 times ARR, which implied a valuation of about 65 to 98 million. However, depending on the specific metrics of the business, the valuation could still fall significantly below the range or come in significantly higher. So let's take a look at the reasons why from a buyer's perspective. So you can start to see this is where the valuation exercise becomes a lot more disciplined. We stop saying the company should be worth 10x because SaaS companies used to trade there at a time. Instead, we ask, what does this business deserve relative to the market today? So if you look at some of the quantitative and qualitative factors, we can start to understand how individual businesses are valued. So I'll give you, we won't go through this line by line, but I'll give you some examples. If the growth has slowed, that might pull the multiple down. If retention is excellent, that might pull the multiple up. If there's no customer concentration, that reduces buyer risk. If NRR is strong, buyers can underwrite expansion revenue, not just new logo acquisition. If the company is a clear leader in a defined vertical, a strategic buyer may apply a premium because they're buying access to the market, so not just the ARR. So this is the reframe. The valuation isn't based on one headline number. It's based on how much risk the buyer has to underwrite and how much value a motivated buyer places on the business. So yeah, this is one of the most valuable exercises we do with founders. By recasting the business in this way, we stop thinking about the valuation as just a single multiple, and we start thinking about it like the buyer who's actually writing the check.
Yeah. And I think one thing to add here that there may be some of these metrics could be like red lines for a buyer.
Yeah.
Yeah. So for example, if customer concentration is too high, doesn't matter. Everything else could become irrelevant. They could say, look, sorry, we just cannot take on this risk. We don't feel comfortable taking. Or if GRR is too low, it doesn't matter what all the other metrics are. Some companies, especially private equity firms, they have, firm guidelines that the IC expects for GRR. If you don't meet that threshold, then it's a no-go no matter. Some of these could become kind of no-go metrics, but assuming there's no red lines have been crossed, then everything else is assessed in conjunction with the broader picture.
So let's look at how we actually build a valuation range in theory. The first method is public peer analysis. So at first glance, this means this might seem straightforward, but sometimes finding a listed software company that matches yours or is similar to yours is quite difficult. Public companies, and also it's not a direct comparison. Public companies benefit from liquidity, they benefit from scale, analyst coverage, easier access to capital, and sometimes private companies don't. So that's why certain adjustments are necessary, why those valuations are discounted. So we start with comparable public businesses and then work backwards. How does this company compare on growth? How does it compare on profitability? Is it smaller, less diversified, more concentrated? Every one of those differences deserves an adjustment. So public multiples are a useful reference point, but they're not the answer. They're simply one piece of the valuation puzzle.
Yeah, and here again, you'll see why valuation is not formulaic, right? Because you take you find a relevant public peer, and you say, okay, I deserve a premium to them or a discount to them, and the discount, and while everyone might agree that you deserve a premium or a discount, why would it be 30%, not 15%, not 20% or 80%? That's where the qualitative aspect comes in. And that's, that cannot be, there's no formula that will give you the right answer here. It's a discussion.
The second method is precedent transactions. So, similar companies to yours, privately held companies that have transacted. This can be difficult sometimes because the multiples and the valuations aren't always public. But it's often what the first thing founders ask. What did a company like mine sell for? It's a sensible question, but like I said, very difficult to reference because no two transactions are identical and no two companies are identical. Headline multiples rarely tell the full story. We don't know if there was an earnout. Sometimes we don't know how much cash was paid on close. We don't know if the buyer was acquiring the technology, the customers, or the talent, where the synergies, and what the synergies were that justified that premium. So without that context, comparing transactions can be a little bit misleading. We don't use precedents because we expect history to repeat itself. We use them to understand how sophisticated buyers have valued similar assets under similar circumstances. And that context is extremely important.
Yeah, and again, remember, none of these in isolation give you an answer, right? These are all multiple data points that come together with a narrative, together with a negotiating stance, together with kind of the advisor's sense for how much negotiating leverage you have, etc. It all comes together into a mix to get to the final discussion.
And then we have discounted cash flow. This is a very simplified example, just to kind of explain the concept. Founders sometimes assume this is the most accurate valuation method because it's mathematically rigorous. In reality, it's only as good as the assumptions that sit behind it. So you can play around with the growth rate, you can change the margin assumptions, you can change the discount rate, and then the valuation moves significantly. That's why we don't just rely on DCF in isolation. We use it as a sense check. Does the valuation implied by future cash generation broadly support the range we're seeing from other methodologies? So it gives us another perspective, not the definitive answer.
Yeah, and also gives us kind of an order of magnitude, but it's very important. You might wonder, okay, if these don't give you a clear answer, and if there's a debate around them, how are they used? And the fact of the matter is that they are used if the assumptions are reasonable, right? So an IC. So if you're a buyer and you have the deal team, the buyer has a deal team, the buyer prepares a valuation analysis after discussing with the sell side, and they put together their analysis with their DCF and their assumptions. The IC will look at them and they will say, okay, are these assumptions reasonable, right? The terminal, I'll just take a very specific example. Terminal growth rate, 3%. Does that pass the smell test? 3%. It's a bit punchy. In reality, it should be closer to 2%. Yeah. Discount rate, 18 to 22%. Why is that? And then, so all these assumptions need to pass the smell test. Now, it could be, instead of 2%, it could be 2.2% or 2.1%. And that will change the valuation, but still, when you put one valuation method with another, plus a few other factors together, and each of these have assumption that's passed the smell test, that's what on the buyer side, the IC needs to be able to see in order to give its approval. Yeah. On the sell side, of course, we will push as far as we think is reasonable. We will put forward challenges to their assumptions that we think are material. And on the sell side, of course, it's also a balance between, pushing the assumptions too hard and too far, pushing it maybe potentially too much, that the buyer ends up saying, well, sorry, this is just, out of my range, and they end up walking away. So there's also a balance to how much you can push on the sell side these assumptions.
So at this point, we have something much more useful than a subjective anchor. We have a valuation range that we can actually defend. We've got, each methodology answers a different question. Public peers tell us where the market is trading today, but they're not perfect because public companies are larger, more liquid, and often more diversified, and might be operating across multiple geographies. Precedent transactions tell us what buyers have paid for similar assets, but the data is often imperfect, incomplete. The best deals are private, and the headline multiples may not show the structure. DCF tells us what the business could be worth intrinsically, but it's highly sensitive to assumptions, as Georgios mentioned. A small change in growth, margin churn, or discount rate can move the output significantly. So we don't use one methodology in isolation, we triangulate. And it's important to note, this is not a range that we lead with in the market. It's an internal reference range we use to assess buyer feedback. We assess their seriousness, and it's a point that we can negotiate from with discipline. So we don't go to the market saying, look, the valuation of this company is 89 million. I think hopefully we've established that that's a mistake now. If you lead with a number too early, you either cap the upside or you scare buyers away before they've had the opportunity to build conviction. So instead, what we do is we let buyers underwrite the opportunity. We provide guidance on their bids and not a hard anchor. And the goal is to create enough structure that buyers understand the expectation without removing the possibility of strategic outperformance. And so the kicker, probably my favorite slide, you can have the best valuation study in the world, but ultimately your business is worth what a sophisticated buyer is willing to pay. No more and no less. And the right situation, in the right situation, valuation methodology can quickly become secondary. We've seen competitive processes where, like we said, where most buyers were clustered around the same valuation range, but one buyer came in significantly higher, because for that specific buyer, the acquisition unlocked revenue opportunities, had strategic access, product capabilities that simply no one else could underwrite in the same way. So they were not paying the market price; they were paying for what the asset was worth to them. And that's where a good advisor is worth their weight in gold. If you have an outlier bid, our job is not just to celebrate the higher number, it's to de-risk the opportunity for that buyer, build conviction, and make sure they can actually close. Otherwise, you risk losing the highest bidder, and then the silver medalist is a significant gap between that and millions of dollars that you've left on the table. So that's why market calibration is so important. You can't spreadsheet your way to the final valuation. You need to build a defensible view, but the market ultimately tells you, what your business is worth, what's strategic and what's executable. Our job is to create the strongest possible narrative, support it with metrics, and then pressure test it with the right buyers. If the market comes back below the founder's expectations, we need to understand why that is. Is it growth? Is it churn? Is it scale, EBITDA, customer concentration, whatever it may be? Or is it simply that the wrong buyers are in the process? The market feedback tells us whether we push harder, widen the buyer universe, or adjust the narrative, or use deal structure to bridge the gap. And that's where experience is absolutely invaluable.
Yeah, and I think people say that companies are bought, they're not sold. Yeah. And what this means is that you cannot you cannot sell a company to somebody. They need to want to buy it, right? So a buyer, is maybe prepared to pay up to a certain maximum, and that's what you need to do through a process. You need to calibrate the market and understand what is the maximum that all the qualified buyers are willing to pay. The trick, as Elie said, is to formulate a process such that the buyers you talk to, in fact, put their best foot forward, and they don't undercut you or they don't lowball you. Yeah. You need to build the framework and create the conditions so that these buyers, through competitive tension, through all the things we discussed, put their best foot forward. Beyond that, there's little else you can do, right? If a buyer is not willing to go above a certain number, then that's, as you mentioned, you need to decide. Maybe you need to take a step back, take the feedback into account. It's very important to get feedback after every bid, and then decide, will the conditions change for you in 6, 12, 18 months, so that you can overcome whatever obstacles the buyers mentioned, or not, and then you need to make a decision how to proceed.
Okay, so just wrapping up, and we'll open up to questions. We've covered a lot today, but the important point I think that we hope that's landed is that valuation doesn't begin with a spreadsheet. It begins with understanding how buyers think. Once you understand that, every decision that you take before going to market becomes a lot more deliberate. What founders get from an advisor-led process is, more. I think we've established now more than just introducing buyers. The value comes from bringing structure and experience to a process. It starts with making sure the business is ready before the buyers are introduced. And as the deal progresses, the role changes again. Buyers test assumptions, new issues emerge, emotions come into play. And this is where experience really matters. So we've seen enough transactions to know which issues are material, what are negotiating tactics, and having someone that's been through that during negotiations, specifically closing price adjustments, for example, can justify the success fee alone. And then finally, appointing an advisor sends a very strong message to the market. Buyers know they're entering a competitive process, a structured process. They understand that they'll be dealing with experienced professionals who know how these transactions should be run. And importantly for the founders, that means less distraction. You can focus on your business, keep your eye on the ball, and ultimately you get better decision making and a much better chance of achieving the right outcome. So if there's one message we'd like you to leave with today is valuation isn't formulaic. It's not a single number. It's the output of everything that came before it. It's the quality of the business. It's your operating model. It's the credibility of the management. It's the buyer universe. It's the timing of the process, the way the business has been positioned, and the discipline with which the transaction is run. You can spend years building great companies and then only a few weeks just thinking about the exit. And I think given what's at stake, that's clearly not enough. The businesses that consistently achieve the best outcomes don't just prepare for a sale; they prepare to be bought, and that mindset, changes everything. All right, so this was the third of the 6-part series. The next one is in a few weeks. We'll send reminders to everyone, and obviously we'll share the recording and the presentations of the last 3. And yeah, we'll just open it up for if anyone has any questions. More than happy to engage. All right, I think if no questions, let's wrap up. Thank you very much for attending today. We appreciate it. We appreciate your time, and we look forward to seeing you on the next session, webinar 4. Thank you very much, and take care.
Good day.
Bye-bye.